Yep. So Abran Villegas, based in Phoenix, Arizona, from Albuquerque originally. Been with Lazier for 3 years. We are based in Columbus, Ohio. I think our secret sauce is that we've got a bunch of tax nerds, both tax attorneys and tax accountants, based in Columbus, Ohio. Folks like me are out in the field and work closely with our execution team in Columbus. Started in 1999 as a sell side advisory firm, but now 90% of our business are ESOPs. So last year we did 45. This year we'll do about 50 ESOPs. It's something that we're very passionate about. Next slide. So we've got a bunch of attorneys, healthcare specialists. My background is 22 years as a commercial banker. So part of the process is being able to find senior bank debt, and that's what we help our clients with as well. Thank you. Next one. Yeah, and so we try to bring a goal-driven approach when we're meeting with you or with your clients. We start with what your particular goals are from a liquidity perspective, from a legacy perspective, and then try to work backwards in terms of what we then provide as a solution. So I promise this is the end of the commercial for Lazier. And here I just wanted to highlight, we do a wide range of industries. I will say that about 30% of our business is in the construction arena, and that's for a couple of reasons. One is that we're typically able to get a higher multiple for those clients. The big reason being is that if you think of most contractors, the relationships that the founder owners have built are very important, and they don't necessarily translate when you sell it to a third party. But when you sell as an ESOP, we're able to monetize that in terms of the value. So not only are you able to sell tax-free and have some of these tax benefits, but you're usually able to get a higher multiple, and that really applies well in the construction area. So what is an ESOP? A lot of folks like to compare it to a 401k, and there are a lot of similarities. I think the biggest one being that this is a defined benefit plan. And when I say that, it means it's also administered by the Department of Labor. And so within the ESOP, there are very strict guidelines and rules that you're not able to discriminate, but for a number of years of service and how much an employee makes. There are guidelines onto how shares are allocated. And so it's a very technical sort of an exit. And for that reason, I think regardless if you use us or someone else, I think it's really important if you're pursuing an ESOP to make sure that you have an expert that understands these transactions. All right, let's next one. And what incentives does Congress have for ESOPs? I think the biggest one is that you're able to sell tax-free as a as an owner. And I think Paul, I don't know if Paul's still on, but in Washington, there was a case last year where there was a retroactive capital gains, and I'm not sure where that's at now in Washington, but I don't know if your company was affected by that at all. But capital gains taxes from a federal perspective are 20%. In Arizona, in particular, it's 2.25% to 2.5% is your capital gains. So all in, if you're selling your business in Arizona, you're going to be paying close to 25 cents on the dollar in capital gains taxes. California, you're 14%. I'm not sure about Rhode Island, but I think New Jersey is also about 12%. Florida's low at 0%, but depending on the state you live in where you're selling, at a minimum, you're going to be paying capital gains taxes. With an ESOP, you're able to avoid that capital gains. The other huge advantage is that as an S corp, if you are selling to an ESOP trust, which is a non-taxable entity, so you as an ESOP, after the sale occurs as an S corp, you are now 100% tax-free from both state and federal income taxes. So you think about probably most of your clients are pass through LLCs or S corps. That there's usually 30 to 40% that has to be distributed to the owners just to cover taxes. That goes away altogether. And so those are the two major benefits, tax benefits that ESOPs provide. And why, may you ask, does Congress giving these freebies away? I think it's one of the few things that both Democrats and Republicans are agreeing on nowadays. Republicans love the fact that you, as a business owner, can sell tax free and avoid capital gain taxes altogether. Democrats love that you're creating wealth for workers that might not otherwise have it. So this has been around since 1974. It's completely legal, by the way. That was my first question when I joined Lazier. It just seemed a little too good to be true. But the great thing, there's some great tax incentives that continue to be very well supported in the community. Uh, and here are a couple of statistics. I don't know if you can go back, Mark. Just 40% of all Americans retire with only Social Security benefits. 65% of American households don't have enough retirement savings when considering all of their net worth. And then this is a shocking one to me. For baby boomers, the average 401k balance is in the 60 to 80,000 range. Not enough to retire on whatsoever. So this is one of the reasons that Congress is very supportive of ESOPs. Josh, I don't know if you know if you have any statistics about like the broader population and what their 401k balances are, but you know, they're usually not enough. So here are the big downsides to an ESOP. The biggest one is it's not an all cash sale. If you're considering an exit and your owner is just ready to go off to South Florida and be done with the business, this may not be the right exit, because you're usually recouping your money on a 4 to 5 year basis, sometimes shorter depending on the cash flow or the value of the company. And then here's another big one. Your owner really has to believe in the future earnings of the company, because that's what gets you repaid, albeit on a tax-free basis. So it is tax advantaged. You do have to have strong earnings from the future of the company. So only an owner who truly believes in the company's future earnings should consider an ESOP. If you have an owner that's maybe pessimistic about what the next few years are going to bring, that might be difficult for them to consider an ESOP. Next one, Mark, please. You're doing awesome, by the way, Mark. Thank you for driving. Uh, Here are some cool statistics that I love sharing. Year one, you're getting a 4 to 5% productivity increase in the ESOP. We had an electrical contractor that had about $1 million in overtime pre-ESOP. Post-ESOP, that went down to zero. So post-ESOP, the overtime was zero. And a lot of that was just self-policing. So it was like, hey, Mark, you're not showing up on time and you're really affecting the value of my stock. And so with a strong ownership culture, you can really drive that productivity. And that just increases it exponentially over time. And that's one of the reasons ESOP companies are half as likely as non-ESOPs to disappear for any reason. You know, a big part of it is that you're not paying taxes, so that improves your cash flow. But a larger part is just that you've got a vested interest by the employees that are working there. In terms of attracting and retaining key employees, ESOPs are able to do it 4 times more effectively. And this is really where if you've got an industry like construction where it's really tough to retain and find new employees, ESOPs are a great exit. And then, as could be expected, economic circumstances for the workers within the ESOP are a lot better than their peers, with 2.2 times greater assets and retirement plans. That's what we work with a lot of wealth managers as well too. Wealth managers love the fact that not only are you able to capture the liquidity for the owners up front, but down the road, as a lot of these employees retire, Sunt Construction and Kitchell are both examples in Arizona. Some of the factory workers and secretaries ended up retiring with 7-8 figure ESOP balances. So it's a pretty cool story. So this is one thing, if you're considering an ESOP, that you really need to pay close attention to. And I think in the past, ESOPs did get a really bad reputation. And I would say ESOPs can make a good company great. ESOPs are not going to make a bad company good. And what I mean by that is if there are circumstances in the economy or changes within a particular industry, well, it does help that you're not paying taxes and you have an engaged workforce. It doesn't cover all of the sins. The other thing is, if you look at how some of the programs were structured in the past, the allocation of shares would happen over a 5 to 10 year period, which means within 10 years, the entire company was owned by the employees, not just by the trust. And I'll get into allocation in a second. But what that created was a huge liability up front for the ESOP before they had paid off the owners and before they were able to build up enough cash to be able to cover those liabilities. So as part of our services, what we look at is how the allocations of the shares should be. In some instances, we've had a 30-year period. That's probably the minimum. In some instances, we've allocated shares over 150 years. And that was a place where there were not a lot of workers, but they had a high value. And again, you don't want to create a liability too large, too soon that the ESOP cannot handle. And then, like I mentioned, you got to be sure that you're following ERISA guidelines within the Department of Labor. And so the only way that you can discriminate within the ESOP is based on total compensation and or years of service. And so we work with the owners to try to understand that and make sure that it's within the law. And then the ESOP has a repurchase obligation for death, disability, and retirement. They have up to 5 years to pay out the retirees. And then upon termination, for any reason, there can actually be a 5-year waiting period. So these are structures that are put into place that we help our clients put into place so that you're not bankrupting an ESOP before they're able to season and build up the cash they need to buy out their retirees. And then just a reminder, the shares are allocated over a 30-year period. These shares are valued on an annual basis by a third-party independent appraiser. And we think that component is important as well. There have been instances in the past where it's the company that acts as their own trustee and valuation firm, and that's a big no-no. So just some sample ESOP designs and information that we've put into place. All right, Paul, he has a question. What is the best structure for a company when contemplating an ESOP, e.g. sub S, C Corp, et cetera? Does it make sense to change the entity type before an ESOP? I would say talk to your advisor before you're changing the entity type. This is getting a little bit in the weeds, but in order to take advantage of 1042, which is the way to sell tax-free, you have to sell as a C Corp. And in order to take advantage of the company being tax-free, you have to be an S Corp. So there's something called an A reorg that the accountants on the phone may be familiar with, but you're able to go from a C to an S in one calendar year. And you can do that if you're contributing other assets or LLCs into the ESOP. But I would probably, before you're making a C Corp election, would engage an advisor that would help you walk through that process in conjunction with your CFO. Paul, I'm curious, I don't know if you can come off mute, but if you have any updates on that, the capital gains clawback in Washington.
No, I don't. We haven't run into that yet, but it's just Washington's way of slowly getting us to an income tax.
Yeah. And what is it? What is the capital gains tax there?
I can't remember off the top of my head. It's one of those things that's like I read it, understood it, and then since it didn't affect us, I kind of put it off to the side.
Yeah, I want to say it's I think it's double digits though, or 10 or 11%. It's not as bad as California at 14, but I think it still is double digits. But if you were in Washington,
right now it's 7%.
7%. Okay, maybe not as bad. So if you sell your business in Washington, you're looking at a 27% capital gains between federal and state. If you were unlucky enough to sell it, I think in 2023 is when the clawback occurred. There was no capital gains, and then there was a 7%. So again, if you could sell as an ESOP, you can avoid it altogether. That'd be my advice. Thanks, Paul.
Thanks.
Did that answer your question on the structure, though?
Absolutely. That's what I was looking for.
Okay, great. Excellent. Thanks for the question. All right, Mark, next page. So you think about your sale options, and I'm going to start with comparing an ESOP to a third party, and then I'll compare an ESOP to a management buyout, which has some interesting nuances as well. When you sell to a third party, you're usually taxed at least at 20 to 30%. Versus an ESOP at 0 to 25%. You can always choose to pay the capital gains if you want. The government's not going to discourage you from doing that, but we have ways to avoid that. Uh, on a third party sale, there's an upfront payment. I'd recommend trying to get as much as you can up front because a lot of private equity is pushing towards looking at an earnout, which apparently is about ends up 50% of those earnouts end up in litigation, and a lot of times they're written they're written in favor of the buyer, meaning, I've seen the buyouts where sales have to increase by 30% and profitability has to increase by 20 and costs have to come down by 15. Venus has to be in retrograde before you can get 100% of your earnout. And so a lot of attorneys will say, when you're selling your company, just rely on what you get up front. On an ESOP, you do get less up front, but you also get fixed payments, which will go through. And then also interest and warrants, which are a really cool tool that I'll talk about as well. So sale to third party, your predictability is I've heard as well too that once you get to the LOI phase, that 50% of purchases actually occur. In the case of an ESOP, you have a willing buyer and a willing seller, so it's 100%. We close 100% of our deals. The other thing is disruption to operations. If you've ever been in a sell side process where the owners it gets out that you are potentially selling to a third party, there begins to be a lot of water cooler talk, and people, your top employees start looking for jobs. It might be looking for jobs elsewhere, leave the company. It can be very disruptive. Whereas if it gets out that you are actually doing an ESOP, that's not a bad rumor to get out in the company. And we're less disruptive from a management standpoint as well. You're not having 20 different management meetings and different sets of private equity groups come into your company. We can really minimize that effect. Employee impact of the third party is unknown, but is very positive from an ESOP perspective. Again, because of the reasons I mentioned before. Likelihood of close 100% with an ESOP and unknown with a third party. And then here's a big one for a lot of your owners is the post-close involvement. So I don't know if any of you have been involved with any owners who sell and actually have sellers regret. And that's a real thing. As a banker for 20 plus years, I've seen it time and time again. And I usually think the timeline is about 6 to 9 months where an owner has done the world cruise, has perfected their golfing game, has joined a new country club, and then they start to get bored, and then they also start to realize that a big part of who they are is tied up in the company that they started, and a big part of their family is still working or their friends are still working. And so with an ESOP, this allows them the opportunity to stay on and exit on their time frame, and exit, continuing to be a consultant or on the board, and to continue to be involved with their company. Next one, Mark. Yeah, I love this slide too, because it talks about, a lot of a popular way to exit is actually a management buyout. But if you think about it, you end up being taxed twice in a management buyout. So let's think about your typical S Corp or LLC. You have a management team that more than likely does not have the liquidity to buy out your owner. I had a customer that the gentleman was 75 years old, contractor. His management team wanted to buy him out over a 40-year carryback note at 4% interest. So he would have collected that all of his money back at 115 years old. So great deal for the management team, not so good for the owner. Again, how are you going to get the money to repay that owner's note? Well, it's going to be through cash flow of the company that is taxed at 37%. Federal, and then depending on the state you're living in, you've got a state income tax. But then your owner's going to be paying capital gains on top of that. And so they're in this scenario, it's 20% federal and 5.75% state. So effectively, in this particular scenario, and this is actually for Ohio, where we're based out of, you'd be for every dollar in cash flow, only 42 cents would actually go to the owner. So it's incredibly tax inefficient, and that's why it is in a lot of times takes so long for the management buyout to occur and for the owner to get their money. I'll pause there to see if there are any questions. And the other thing is a lot of owners, a lot of management team, they may be able to finance some of the purchase price, but then they're going to have to assign personal guarantees and a lot of times give up their homes as collateral. Management teams don't necessarily like doing that, and so that's another consideration of a management buyout versus an ESOP. Okay, next slide, please, Mark. And so there are a few parties involved in an ESOP, and our job as your investment bank or whomever you hire as your advisor should be representing you as the seller, should be representing the selling shareholders. So we're there to advocate for value. That's the biggest one. We want to be sure you're getting the full and fair price for your company. We talked about that goal identification up front. And what really surprises me, I guess maybe just I shouldn't have been surprised, but as a greedy banker, I thought that what is really of interest to business owners would be the fact that they can sell tax free, their company becomes tax free, you're making all of this money, you're making a lot more money than if you sold to a third party. What most really good CEOs really care about is protecting their legacy, rewarding employees that have been with them from the beginning, and creating a legacy for themselves. So don't underestimate that when talking to business owners. I certainly did. I thought that maybe the tax piece was the most important, and the fact that you're getting more after tax dollars than a third party sale. But I think that personal, depending on what their personal goals are and what their strategy is for the future, the ESOP can be very attractive from a legacy perspective. We're there to negotiate with the valuation firm, an ESOP trustee, negotiate financing with lenders, and manage the deal process. On the sell side, you've got the selling shareholders, key employees, company counsel, your accounting firm, a third-party administrator, and then wealth advisors. And all of those play a really big role within the selling shareholders team. And then on the ESOP side, technically the person buying your company is the ESOP trustee, and they are there to act on behalf of the interests of the employees. So it's an interesting dynamic because you as a selling shareholder are actually hiring the trustee and then negotiating against them. And then once the ESOP closes, the trustee actually becomes your partner and is there to advocate for the employees, but also is paid and hired and fired by you as the shareholder. So it's kind of an interesting dynamic. And then Jay, yes, I will definitely share the deck after this as well, and it will include my contact information at the end. And happy to chat with anyone about it. I'm passionate about ESOPs, as I hope you can tell. And then another key role is the ESOP trustee will hire a valuation firm, and this valuation firm will give a value to the trustee. They won't share it with you year one, but they'll give it a value range to the trustee, and that's what the trustee will then negotiate with and end up with a final value. And that valuation firm will probably be the same one performing annual valuations, which then give you the share price of on an annual basis. And then the trustee also hires a counsel. So a lot of professionals are involved. I would say you should expect anywhere between 4 and 5% of the purchase price in fees, total fees, as part of a transaction. And that's why I mean a lot of times we're looking for a minimum of 1 to 2 million in EBITDA at a minimum to make this work because of the incremental fees. Next, please. Mark, you're hired, by the way, too. I think you're doing an awesome job. Thank you. All right, tax benefits unique to ESOPs. We talked about the big one, 1042, ability to eliminate altogether your capital gains tax. 100% S Corp ESOP is exempt from federal and state income taxes. And that's the story you got to tell your banks as well, too, that you've just charged up your cash flow by 25 to 45%, depending on your owner's tax brackets. And so that's a great, your cash flow is just a lot better with an ESOP. We have something called a pre-closing ESOP contribution deduction. I won't get too much into it, but it's a way to write off some taxes in year one, even before the year before that your ESOP is actually implemented. And then warrants as an estate planning vehicle. I'll get deeper into this, but at its core, what's really great about a warrant is it gives a second bite at the apple to your owners. So if you have some owners that think that there's some great upside potential based on some of the growth they're seeing into the future, we can have a warrant in place that allows them to participate in that upside. So I'll get into that in a bit. Next page, please. So I don't want to belabor this, but for those of you familiar with real estate, there's a section of the IRS code called 1031, whereby you're able to roll over into a like to like asset and avoid capital gains altogether. We have the similar code for ESOPs that is 1042. Lazier has some interesting and proprietary products that allow you to be out of the ESOP within a year. And the good thing there, or be out of the tax liability within 1 to 2 tax years. And the good thing there is you're not having to roll over into assets until you pass away and then take a step up in basis. But that's sort of for the ESOP 202, and happy to talk offline with anyone that's interested in learning more. Next, Mark, please. Yep, let's yeah, and I'll just briefly, just like on a 1031 exchange, you're needing to invest into qualified replacement property. Most of those are corporate floating rate notes. And then we have a proprietary structure. We're happy, I'm happy to go into further detail with anyone that's interested. Next. So this just shows that, if you were to sell to a third party, you'd need to sell for approximately 33% more to get the same after-tax benefits of just the sale price. On the next slide, I love this slide. Because it just shows how particularly how in particular an ESOP is financed. And I like to use the analogy of a house. So you think about a $10 million house. At closing of this $10 million house, when you sell it, you've got a seller note for usually 65 to 75% of the purchase price, and then you have some bank debt at 25%. So at closing, there is no equity in the house. As the value of the house grows and as you pay off the debt, that is the equity that's unlocked that you're able to distribute to your employees over time. The good thing about this carryback note is the ESOP is actually paying the owners, so the former owners, paying the sellers interest of between 12 and 14%. And that is a combination of just 4 to 5% just interest, cash interest that's paid. And then the remaining portion is in this form of a warrant. And essentially, it's an option to purchase up to 20% of the company after your seller note is repaid. So again, that's the second bite at the apple. We had a company which the warrants ended up being worth as much as what the sale price was, because they had grown the company so much and had really their employees had really embraced the ownership culture, and they were able to double their money through that warrant. The cool thing about the warrant for those people that do wealth planning is that it is worth zero when you close, and you're able to get it completely out of your estate. Some people have explored using Roth IRA, or putting it into a irrevocable trust or into the trust of their children as a way to get it out of their estate. So there's some interesting things that you can do. The other cool thing is cash pay interest is taxed at ordinary income. These warrants are taxed at capital gains. So that's another tax saving measure as well too. One thing to note on the bank loan and the line of credit is we require that the banks have no personal guarantees on on this debt. So it truly is non-recourse to the sellers. Next, please. Yep. So this is just puts words to what I just said. Again, you're getting some cash pay interest and then a warrant down the road. And keep in mind that a lot of these CEOs end up staying on as CEOs, at least for a couple of years. And I've seen every flavor where you've got CEOs that maybe bring on a president that then transitions to a CEO after 2 years. I've seen folks that just already have a good management structure in place, so they just stay on the board. It really is up to your owner how they want to exit. But if they do stay on as CEO, keep in mind they're still gaining the salary. They still have a bonus structure. They still have benefits. Plus, they're getting these interest warrants, interest and warrants on top of it. The next slide. And this just shows the dark green is your bank financing at close. What we're doing is every year going back to the bank and saying, hey, bank, we've paid you down. Can you just re-up the debt? The reason being here, as you recall, we're paying your owners 12%, whereas we're probably paying a bank 7 to 7.5%. So this is a way for them to minimize their interest expense, is to maximize the bank debt as quickly as possible. That spike in year 5 is actually the refinance of the warrant as well. Next, please. So this is cash flow to your owners. And the cool thing is that we as an investment bank are only charging for that dark green and the lighter green. So that's the sale price of your company. But the benefit to your owners includes the interest, which is that light green on the top, and then the warrant at the far right. That light brown is our additional benefits to your client or to your owners as well. Next, please. And this is what I love. So, like I mentioned, within the ESOP, you cannot discriminate. The way that we structure our ESOPs, though, we include a what's called a stock appreciation right, which is similar to a warrant that it usually vests after you are, if the owner is repaid, but you are able to give any of these SARs, stock appreciation rights, outside of the ESOP to any executives that you choose. So we usually recommend that these are folks that really are driving revenue or reducing expenses. Your top C-level employees, you're able to give these to them in addition to their participation in the ESOP and in addition to their salary and bonuses that you're providing. So usually the way they work is that if you meet your goals in year 1, you get a SAR payment in year 6. If you meet your goals in year 2, it's a SAR payment in year 7. And these can be huge payouts over time as well, to 7 figures as well. But that you're able to use as a CEO to continue to reward those top employees that really drive the revenue and discriminate however you feel is appropriate. Next, as long as it's legal, I should say that. And then for your employees, it's not a slide here, but it's really incredible over time the wealth that you're creating for these employees. I got into this business because I have an uncle and a brother-in-law that both worked for Dunn Edwards Paint in Phoenix, and it was a way for them to finance my niece's college education. My uncle bought a house. I think he might have been homeless otherwise. And so it was really life changing. So not only are you changing the life of your owners, but you really are changing lives of hundreds and thousands of employees that wouldn't otherwise have a retirement plan. So that's why I'm really passionate about it. I'll leave you with a couple of statistics. In Arizona, in particular, 80% of businesses that sell to out-of-state buyers. So you think about what could that might do for our local economy, what that might do for our CPAs, for our banks, for the people that depend on these corporate headquarters being in Phoenix. So I'm really passionate about trying to keep the companies local through an ESOP. Next steps for anyone interested, we do a free feasibility analysis, and that includes a value range of what we think your company would sell for as an ESOP. We're unique in that we also do some M&A. If you are interested in a third-party sale, we can show you both your M&A, a third-party exit, and your ESOP exit. It just so happens that 90% of our owners choose the ESOP exit for a lot of the reasons that I just went through. And then we'll do the full tax analysis and do a deep dive into what we recommend the structure, both from a corporate perspective and a company perspective look like.
Quick question on a third party valuation entity that's necessary for this. How often do you find that uh, something's wildly off based on, so is it 5 to 10% of your expected valuation, or is it outside of those bounds?
Well, I will say, I don't think I've ever had a conversation where the owner thought we were going to give him more than he or she thought the company was worth. So, a lot of my job is saying, a little bit, your baby's not ugly, but it's not, here's some of the issues with it. So we try to lead though with the numbers, James. Like, it's not about what I personally think about your company, but it's like what this is what the market's going to bear with the third party sale, and here are some things to fine tune. And a lot of times we'll have the conversation, we think you should fine tune A, B, and C, and let's look at selling your company, whether it be a third party or an ESOP, a year from now. So we have a lot. I mean, some companies I've been talking to for 3-4 years. So I would say value expectations are always higher than the reality. But I don't know. But I'm sure. I'm sure I'll be surprised one day when an owner says, "Wow, I was thinking it was 10 million less."
Oh, no question. Yeah, 99% of the time. Yeah, absolutely. Yeah.
Seems like a great group. I appreciate the questions and the engagement. My dad was a teacher, and I always felt guilty about going the banker route. So I tried to make up for it by valuing education, especially around ESOPs. And I think every owner, regardless if they end up going the ESOP route, should consider doing an ESOP, just because I think it can be a really really powerful exit if done right as well.
What are some of the reasons owners don't go the ESOP route?
I think the big one is that they're tired and they don't want to work anymore, and that they don't necessarily have a management team in place. So they just really want to be done with it altogether, and they want the cash up front, and they don't have it in them to stay on another 3 to 4 years, or they haven't built up the bench strength to be able to just hand off a company within a couple of years. But I think what happens is a lot of them don't realize that a lot of private equity groups are going to require them to stay on through an employment contract for 2 or 3 years anyway. And so there's no such thing as just a free lunch where you can just, most of the time they're going to have to stay on in some capacity post sale. But I think that's the biggest reason, is they just want they want an upfront. And then some owners are just too young, and they want to wait a couple of years to try to increase their EBITDA and the value of the company and build some management.
How long does it typically take? I mean, once the owner decides, hey, let's go get ESOP process.
Yeah, so we're running about 3 weeks on our feasibility analysis. So as long as we have all the information that we need, we'll do a feasibility analysis in 3 weeks. Once we're engaged, it's usually a 3 to 4 month process, and a lot of that is going to depend on how quickly the owner wants to move, or the C-suite or the CFO wants to move. That's usually a 3 to 4 month process, and it's a lot less invasive than a third party sale. And I've done both, so I can, I know that for a fact. A lot of owners don't have anything to compare it to, so I'm not saying it's a easy, seamless process, but we try to make it as seamless as possible.
One other question: you mentioned owners having an inflated value of what their company is worth. How do you kind of bring them back down to reality, or maybe prepare them for that before you get into the transaction? Because I've run across that before. It's always worth more than you think it is, and everyone understands that, and everyone knows that except them.
My baby's not ugly. Come on. So we do a lot of analysis up front, and I will say, I should knock on wood, of the hundreds of ESOPs we've done, we've never been wrong on value. We've come in higher, but we've never been lower. And so what I think is really important is to dive pretty deep up front and spend time quantifying with the owner what their strategy is and what their growth trajectory is. And through those conversations, we usually can prepare an owner for, hey, it's closer to 70 million, not 100 million that you're thinking, or whatever the case may be. So we try to prepare owners for that upfront. What's also cool and inherent, like we went through on an ESOP, is, well, if you do think there's some upside, well, we'll give you that warrant. You have that second bite at the apple to participate in that upside. So this isn't your one shot at creating wealth. You're actually going to have that warrant that captures the upside. So that seems to help. I think the warrant is probably the primary thing that a lot of entrepreneurs like. But yeah, it's never an easy conversation.
Yeah, no.
Ron, this is Mark. What's the best way to get started with you? And even before that, just in terms of, I think you've covered it, but maybe just explain again kind of what the minimums are for a company that, would probably work well with you.
Mark, I will talk to anyone just because I'm passionate about it. So, you're $100,000 EBITDA company today, maybe your $3 million EBITDA company down the road. And I just want people to know what that path may look like. So I'll talk to anyone. To do an ESOP, it probably makes sense to be at least at 2 million in EBITDA. Revenue doesn't necessarily matter, but 2 million in EBITDA is because of the incremental costs. That's sort of, what I would say would be the minimum. But we've got a mutual NDA. If companies are interested, we set up a data room, give you a list of information for the RFI, and then put together a feasibility analysis. Again, at no charge to your clients. It's like a $40,000-$50,000 work product, and then they can make a decision based on that.
Wow, there's no commitment for that upfront analysis.
Well, we go pretty deep, so there's some sweat equity on the part of CFO
Sure.
and the owner, because we really want to understand the company so that we can give it a good value. But yeah, no monetary, just sweat
But
equity.
no monetary, yeah. Okay.
I
I think some of
appreciate the
these,
time. These are great questions, and Mark, I'm so appreciative of you and putting this together. I think this, the EPI, the Exit Planning Institute, predicts that 75% of business owners are going to exit in the next 5 to 7 years. If you're an advisor, I'd rather it be an ESOP exit because you keep the engagement, you keep the company local. So I think there's some great benefits as advisors for us to be promoting ESOPs. Obviously, that's self-serving, but it's the reality as well.